I think this was what the market anticipated, and I think you're quite right to point to the decision made in December. At that stage, they made a jumbo cut, and they also indicated that they thought inflation would fall very low in the first quarter to about 0.3%, and that's very much where it is. So I think it's sort of panning out the way the SMB thought it would, and I think a cut now is warranted just to make sure that inflation doesn't go too low.
Is it really warranted? Does this economy even need a cut, given that it has been moving in the right direction when it comes to the employment market, but also growth?
Yeah, that's true. I think some people started to think now in recent days that they might not cut. As you know, the economic conditions in any economy, such as in Switzerland, depends very much on the external economic framework and the fact that other central banks are slowing down cuts. The Fed yesterday, for instance, probably means that economic conditions will be a little stronger here in Switzerland than previously anticipated. But the SMB did the same thing and cut 25 basis points, and it's hard to criticize that decision.
Let me put the multi-billion-dollar Swiss franc question to you. Will it go back towards negative rates? It said before that it doesn't want to, but they do work. Do you think it will?
I don't think they will. I think the inflation rate actually will probably have bottomed out here, I think, in Switzerland, and will start recovering in the second half of this year. The SMB has said that they are not that keen on negative interest rate, but will implement it if necessary. But I don't think that will be necessary. If you think about the central banks, in many cases they're a little bit worried that inflation is stickier than previously anticipated, and inflation pressures are a little stronger than previously anticipated. So I think that will probably impact also on Swiss inflation.
So in the order of the toolbox, Stefan, help me understand. So first comes further cuts, potentially negative cuts, even though you don't think it's very likely. And way after that, currency market interventions. I said on the program before, if you take a look at 24 data, there was hardly anything after massive amounts of currency market interventions the year prior. Does it not need to go down that route, or is it not choosing to go down that avenue because of Donald Trump and the fact that Trump may call Switzerland a currency market manipulator once again? I
think you're quite right to have that ordering. First cut rates and then intervene in the foreign exchange market if you really has to. My sense is that the SNB has been perhaps a little, looking back at it, maybe a little bit, had not anticipated all the longer run effects from intervening so massively, including the political effects now that could play out now with Donald Trump in the US. So I think interest rates first, intervention in the second stage, if necessary.
If necessary, of course. Now, let's talk about the price of gold. Obviously, it's been hitting record high after record high, given the geopolitical concerns. Some people in the market saying the fact that Switzerland has been getting a lot of gold from the BOE and then that is refitted and then exported to the U.S., that could prop up the currency. You don't necessarily share that view. Why not?
I'm not a buyer of that idea. Well, the gold is coming in and going out, and people, financial markets, of course, know that and can look through this whole transaction. So I don't think this will have any impact on the Swiss franc. There is, of course, a bigger issue about political uncertainty, precautionary demand by central banks in particular for gold, and how that's going to play out at the international level. But I don't think this is a Swiss issue.
What about safe haven flows into the Swiss in general? Many market participants have pointed to the fact that they weren't all that strong. Why is that? What's your view? Well,
so far we haven't really seen any really bad news, if you like. But I'm quite sure that if things were to go haywire someplace on Earth, there would be strong inflows in Switzerland. Historically, that has happened so many times, and it will happen again. That is a sort of a regularity, if you like.
Very briefly, let's talk about the Swiss domestic economy here, because as I pointed out before, it has been growing somewhat, but it's so dependent on the export sector, specifically what happens with the northern neighbors, with Germany, with that huge fiscal package now, infrastructure spending, defense spending. Are things looking a lot brighter for the Swiss economy as well?
I think they're looking a little bit brighter, and certainly more spending by the German government will be good for the Swiss economy. But structural reform in Germany would, of course, be even better. They would get the whole sort of engine of the German economy humming along in a nice way, and that would have a big impact on Switzerland. But surely more government spending will also impact on the Swiss economy, and that's helpful, although not as helpful as a bigger bazooka with the structural reforms would have been.